goodbye to all your money. Depends on where you got it, but yeah, it could be. Who's got money? What we're finding out as this crisis unfolds is those who we previously thought had money are discovering they don't have as much as they thought they had. And those that we previously thought had no money, they got a lot more money than we thought they had, because all of a sudden they're asking us what they should do with it. All right. What I want to do tonight is we're going to do a bit of history of the last 20 years of this financial system to get a perspective of where we are right now. Is this recording okay, Chris? It's all right. But I don't need a microphone? Okay. To get a perspective of where we are right now. And the main thing is this. This could be it. But what? Well, yeah, but by it, when I say that, everyone thinks what? Jesus is coming back. Well, I can't tell you that. No, this could be it, which everyone who's been following Lyndon LaRouche for 15 years has been waiting for. Because in June 1994, Lyndon LaRouche forecast that the presently existing world financial and monetary system will disintegrate during the near term. And 13 years later, I've got people saying to me all the time, LaRouche has been saying this forever, when's it going to happen? So what I'm saying to you now, this could be it. As of August 8th, 2007, this could be it. But there's a qualifier, because this is a system, a financial system controlled by human factors, which is desperate for it not to collapse, but it's highly unlikely they'll be able to keep it going. And the decision by the US Federal Reserve not to raise interest rates today is very much a strong indicator that they don't think they can keep it going. Because they didn't raise interest rates and they didn't drop interest rates either. They kept them on hold, which means they did nothing, which means they don't think there's anything they can do. They're, frozen. Quick, don't breathe. Don't say anything. Don't put a puff of wind, in any direction that might be the final straw, right? And that's the quality of the decision by the Federal Reserve today. What's very significant about what's happening right now is what's crashing is the very mechanisms that have been used to artificially keep the financial system up for the last 7 years. Right? That's what's crashing. So what's crashing is what's been underpinning the entire world financial system. And by that I mean the main thing is the derivatives underpinning the property market. In 1994, when LaRouche first issued that forecast, following that, you had the biggest speculative explosion on the Dow Jones and the Australian Stock Exchange and other stock exchanges the world's ever seen. It's just absolutely incredible. I think it was something like it took from 1929 till 1993 for the US Dow Jones to hit 3,000 points. From 1993 until 2000, it went from 3,000 points to 12,000 points. So, 70 odd years to go to 3,000 points, 7 years to quadruple that. In the year 2000, that all crashed quite spectacularly. Now, if I had had more time, I'd have more illustrations, but we've got copies here of the Sydney Rupert Murdoch paper, the Daily Telegraph, in March 2000. Big headline, boom.com, because of course the markets rose on the back of the computer stock. frenzy, right? The dot-com bubble. So March 2003, boom, dot-com. April, not 2003, 2000. April 2000, a month later, crash dot-com, because it collapsed and sunk like a stone, and the Dow went from 12,000 points down to 7,000 points. That was a major crisis. In response to that crisis, what they invented was a new bubble. The computer bubble was collapsed, a new bubble was generated, which, you know, we've all seen quite obviously, the property bubble. But the key thing is the property bubble was created through deliberate measures. The first one was that governments started it, and for Australians, we can remember when Howard introduced the first homeowners grant, right? First $7,000, then $14,000. Whenever governments put money into something, huge amounts of investment follow. So when they did that, they knew, here's the property system. Now, because it's the ultimate irony, right? This was to help make it easier for first home buyers to buy homes. What's happened? The opposite. The $7,000 to $14,000 that first homeowners were able to get to buy homes worth $200,000 then, the same homes are now worth $600,000 and $700,000. Completely out of their reach, even with the bonus. But that was the point. It had nothing to do with the first homeowners. It was governments putting money into property, on the back of which a massive amount of investment flowed, right? Speculative investment, because it's all done through leverage, and before you know it, over the course of the next few years, these property levels just balloon spectacularly. What we're discovering though now is it wasn't just the normal speculative frenzy that drove it up. In the last 12 months, we've become very familiar with this term, subprime mortgages, right? Now, does everyone here, you're aware of how subprime mortgages operate? You are? Good. The main thing to understand is these are, when you're lending money, what is the logic? I'll ask you guys, you tell me, what's the logic behind lending money to people who obviously can't afford to pay it back?
To increase the amount of money in the economy, like, even though they're not really going to be able to afford what they're buying, you're introducing money to the economy.
That's right. Did everyone hear what Alan said? The logic is to increase money into the economy. Doesn't matter that they can't pay it back, right? See, Judy, we're way beyond the bankers scheming that they'll get the house. That ain't going to cut it for them. They're desperate to prop up a system. Now, the way they've propped up the system up until now is by coming up with ways to funnel new money into the economy, right? Every time a bank makes a loan, that loan is new money. That's not depositors' funds being on lent. That doesn't work that way. That's what people assume. That's a fallacy. That's the biggest fallacy of the banking system. A bank loan is brand new money. So what the banks wanted to do, now banks, they can create money that way, but they can't just, they can't do it separate from issuing a loan. They couldn't just write in their side of the balance sheet, a figure of money that they want to just invent. They can't do it that way. They've got to issue it via loans, right? It's got to be issued against some asset, However they justify it, however leveraged it is, doesn't matter. There's got to be some kind of asset there. And so they didn't care, right? They needed to keep expanding the new money going out, and this property market expansion was the key to do that. So if you got banks lending home buyers $200,000 in the year 2000 to buy a property, 2 years later, for the same property, they're lending $500,000. And then they can go to even higher amounts. Have you guys noticed what I've been noticing in the last few months? The amount of ads promoting the property market, the amount of current affairs shows promoting the property market, right? And it's all, I saw one, last night about some strip of beachfront, some Sydney footballer has bought for $120 million. Oh, this is great, this is a big, and then some, last week some home owners that bought their property for $800,000 just recently sold it for $1.3 million a year later, right? And these are all the stories. They're like, ads for Tats Lotto or something, right? They're designed to get people thinking, cha-ching, cha-ching. You got to be in it to win it, right? You got to be in it to win it. And the majority aren't finding that, of course. But this is all, they're pulling out all the stops to keep this, to try and keep this up. But it's going to be impossible for them to do because there's been a distinct shift. And the distinct shift is, if you're trying to remember these figures, whereas in the year 2000 in America, 1% of mortgages were subprime, by last year that had risen to 20% of mortgages being subprime. And there was an increase. 2002 there was a bigger percentage than 2001. 2003 by about 2003 I think we got to 10%, right? So each year they're expanding these loans that they're giving to people who can't pay it back. They know they can't pay it back, but that's irrelevant. They're pumping money into the system, and because whether they can pay it back or not is a lesser evil to letting the market as a whole come down, right? But there's always got to be a payday, and so for the last 18 months or so, in an accelerating fashion, there's been a massive wave of default that's getting bigger and bigger and bigger from subprime mortgage holders in the United States. And these are little people. That's why they subprime mortgages. They can't afford the mortgages, right? They're the little folk. But on the back of their defaults, their bankruptcies, rests the entire superstructure of the world financial system, right? On the back of them, because through a number of mechanisms which we'll discuss in more detail. Now, just to set the scene though, some of you may have seen this, some of you may not. What's happened in, what we're seeing in, say, the recent month or so, there's been a major US bank, Bear Stearns, get into deep, deep trouble on the back of this. Through its hedge funds. Bear Stearns hedge funds are in a big meltdown. And these are big hedge funds. They've had to freeze their assets. They can't pay out the investors, and it's a total crisis for Bear Stearns. Now, in the last fortnight, a lot of other hedge funds have gone under, as well as 6 Australian hedge funds. Basis Capital has 2 hedge funds. Absolute Capital has 2 hedge funds. And what we found out last week, Macquarie Bank's 2 hedge funds, which funnily named the Fortress Funds, right? They've gone under. So this is a big, and they've gone under because of their exposures to America, not because of their exposure to here. These are Australian hedge funds getting sucked down because of their exposure to America and taking Australian superannuation funds with them. The funds haven't collapsed, but the people are finding, apparently in Perth, a whole bunch of super funds are invested. They're discovering that my super was invested in these things called hedge funds. I don't even know what hedge funds are, right? And they're finding out in the last fortnight they're losing copious amounts of money. So this is when it's expanding, when it's hitting everybody like that, you can imagine a fair amount of panic is starting to set in, right? Now, so we imagine that. We're not Wall Street traders, we're political activists. We're more interested in what you do to fix this, to sort of replace this system, right, which we'll talk more about later. But on Friday, a famous Wall Street trader named Jim Cramer was being interviewed in his regular spot on the financial channel in America, CNBC. And in that interview, they started talking about Bear Stearns. And watch what happened.
Everything sort of starts out down a little bit, but nothing to worry about. Boring summer fight. Almost, a day we haven't had in a long time. Just not exciting. Then all of a sudden S&P says, ooh, we're worried about Bear. bear goes down, market goes down. And then all of a sudden things kind of calm down. Bear comes out and says, hey, we're okay, guys, we're okay, everything's fine. Bear goes back up to neutral, market's only down 20.
Right.
Then bear comes out and says, oh, worst bond market in 22 years.
Yeah.
And that's where we are right now. The market's down 100 points. How do you trade this?
Remember the Bear Stearns. You got to adopt a Henry Ford attitude here, which is never explain, never complain. And they didn't do that. You keep your mouth shut during this period. You don't say a thing because you're going to say something that people don't like.
But then we complain and we say, hey, come on, guys,
keep your mouth shut.
Come out here and talk about your exposure.
No, you speak softly and you wait to that level where you think the shorts have overdone the stock, and then you do what Dick Fold did in 1998. You pick up the phone to guys like me and you say, 32 bid, 1 million, and then you get whacked and you come back and say 31 bid for 2 million. They're not doing that. That inspires more fear. I don't want to create fear. I like Bear Stearns very much, but I think that at this stage, this is not a good call. They shouldn't have done it, and they should have just said, you know what, we're doing well, and don't say another thing. Just don't say it, because it does not inspire confidence to have 10 headlines coming over about what to do. I don't like it.
All right, I hear you. Now, I still, though, you know, when we said, hey,
look, the Dow can rally. We've seen the Dow rally.
No, I know. I'm not even, but I mean, it's just interesting, this bigger...
Well, this is about Bernanke. This is about Bernanke. He has to be on that call. Forget the investors. The investors are going to do, if Bernanke listens, Bernanke needs to open the discount window. That's how bad things are out there. Bernanke needs to focus on this. Alan Greenspan told everyone to take a teaser rate and then raise the rate 17 times. And Bernanke is being an academic. It is no time to be an academic. It is time to get on the Bear Stearns call. Listen, open the darn Fed window. He has no idea how bad it is out there. He has no idea. He has no idea.
Kramer.
I have talked to the heads of almost every single one of these firms in the last 72 hours, and he has no idea what it's like out there. None! And Bill Poole has no idea what it's like out there. My people have been in this game for 25 years, and they are losing their jobs, and these firms are going to go out of business, and he's nuts! They're nuts! They know nothing!
Kramer.
I have not seen it like this since I went 5 bid for 500,000 shares of Citigroup when I got hit in 1990. This is a different kind of market, and the Fed is asleep.
Okay, but here's the thing.
Bill Poole is ashamed. He's shameful.
Hold on. I know
he
you're
ought to go and
passionate
read the accredited home document. At least I read the darn thing.
Hold on. I know you're passionate, and I hear you. But at the same time, a lot of people are saying this is, yes, there's certain types of mortgages that aren't available. There are all sorts of issues.
You can't get a darn loan if you're rich like me.
But Kramer, if he did what you said, which seems to me from the way you just explained yourself.
Cut the rate. Open the discount window.
Okay,
cut the rate.
If he comes out next week and cuts rates,
relieve the pressure.
You're going to have, that's going to cause Armageddon.
No, we have Armageddon. I wouldn't try to cause it. We have Armageddon. In the fixed income markets, we have Armageddon.
No, but that's not what they say.
We have Armageddon.
They say, even when I've talked to a couple bank CEOs, they don't say it's Armageddon.
Well,
they say it's repricing. They're very firm about that even now.
Oh, great. Okay, well, let them be calm and then have them call me on the way home like they do every night and tell me, Kramer, what are you going to do about it? Are you going to help us? Are you going to help us? Are you going to stand on the sideline like everybody else and say that it's fine? Will somebody come on TV and tell the truth about how bad it is?
But a lot of people say, these same people say, it's not Ben Bernanke and the rate that matters. The bond market now is completely separate from the rate.
It's entirely the rate.
The bond market is trading separately from the rate.
Look, we'll spend billions in Iraq to build homes. We are going to have thousands of people. We have thousands of people losing their homes right now. 14 million people took a mortgage in the last 3 years. 7 million of them took teaser rates or took piggyback rates. They will lose their homes. This is crazy.
Yes.
I am sorry to be upset about it, but you have to understand what they're saying to me off the record before I come in here every night and every day. And what I hear from these blowhard managers who act like, call someone for heaven's sake. Go call someone. I worked at fixed income at Goldman Sachs. This is not the time to be complacent.
All right.
I mean, darn, sometimes I wish I didn't know anybody so I could just sit here and say, you know what? Just go buy some Washington Mutual and take that yield. Unfortunately, I know too many people, and I'm too darn old.
You are 62.
I've just been around for too long. I mean, look, I got to tell you, he has got to listen to. He's got to call somebody. Bernanke has to call someone.
He is.
He just has to call.
I can't believe he's just sitting there in his little gilded office.
No, they're not calling anybody. Okay. And Bill Poole.
I know what you think of Bill Poole.
Listen to me. There was a president by the name of Hoover, okay? And no one thinks much of him now, the great engineer.
And a quick reminder, all the recommendations expressed by Jim Cramer are solely his and are not the opinions of CNBC and may have been previously disseminated by him. Before acting on a recommendation, consider its suitability for your circumstances and consider seeking advice from your own financial advisor. Before acting on a recommendation, consider its suitability for your circumstances and consider seeking advice from your own financial advisor.
That is the temperature of Wall Street.
That's the most watched video on YouTube today.
Would have been. Apparently, I was actually surprised about this. Koshi put it on Sunrise this morning. You know Koshi? David Kosh. He so that would have given it plenty of exposure, and I was surprised because, you know, normally they just like that disclaimer at the end. They're so freaked out about spooking the market because the whole world financial system is built on consumer confidence, right? You know, if you have a business, you know if you have a motorbike shop, your motorbike shop depends on whether people want to buy motorbikes or not, or if you have if you have a dairy farm, your business depends on whether people want to drink milk or not, right? But the world financial system, the markets, all depend on whether people are confident in it or not. If they lose their confidence and all head to the exits at once, whether it's a bank, the stock market, the hedge funds, the result is always the same: blood in the water, a sea of red. And so they hate that. So Koshi giving that publicity this morning, I was quite surprised about. Chris, you know the youth want that? Okay, good. Oh well, I'll read you a quote in a minute. I reckon we're going beyond the point of having to worry about confidence. We are in a deep-seated systemic collapse, but that kind of thing, it's hard to ignore, right? People like Australian financial traders don't know much more about the system than we do. No one understands derivatives. They see something like that. That guy's an expert. That guy works the system in Wall Street. He's having a meltdown. Now consider what you saw there. You saw a guy whose universe is evaporating in front of his eyes, right?
See, I've never seen him before. I don't know how he normally acts.
He's a passionate guy, but that was unhinged, right? He doesn't normally act like that.
Who's the police talking about Henry Paulson and
Well, I think he was saying Bill Poole, but I'm actually not sure because Henry Paulson's the Treasury Secretary, isn't he? Yeah, so I don't know who he's talking about with Bill Poole. Probably some top, government sort of regulator or something on Wall Street, or maybe the New York branch of the Federal Reserve. You can check that up though. But it's very clear. This is a guy who thinks the world in which he exists is the real world. And it's the world of making money through trading on the markets, right? And they've loved life for the last decade or so. It's been great. They've never had it so good. They think this is this is our birthright. These massive returns we've been enjoying for more than a decade. This should be the norm. That's how they think. Whereas the massive returns 20%, 30%, whatever. Whereas nothing in the real world equates to that. But they're just completely loopy. They're totally disconnected from reality. I read a book earlier in the year by an Australian Financial Review journalist, Peter Harcher, about Alan Greenspan. And the book is about the bubble that Greenspan created in America. And he tells the story of just a normal person, normal guy, an average Joe in America who was an investor, who one of those years, 1998 or something, the value of his share portfolio did not grow as fast as it had in 1997. And this guy wanted to sue somebody, right? He was asking the authorities who he could issue a lawsuit against because he was not getting the earnings that he figured were rightfully his based on the growth rate the year before. right? That's just, what's that got to do with reality? This is gambling. That's all it is. You think you have a right to it, right? But you know, the total disconnect is what set these people up. So here's a guy who's completely disconnected from reality. This has been his existence, and what he's all of a sudden discovered is that everything's gone pear-shaped, right? Now, he's worried about his firm and the workers who've been there with him for 25 years and whatever. How many tears did he shed for the tens of thousands and hundreds of thousands of auto workers laid off over the last couple of decades in America, or any of that? None. In fact, he would have been making trades to make sure they did get laid off, right? Doesn't really give a stuff. That's not a compassionate man you're talking about. You're looking at. He's just a guy, a baby boomer, dare I say it, who's so obsessed with his version of reality that it cannot compute for him that something's going wrong. So then he starts stamping his feet and he makes a demand. But the demand he makes is, in a sense, a right one. Open the window, i.e., it's called the discount window. Lower interest rates. Increase the amount of new money being pumped into the system. That will make this all fine. My pain will go away, right? Because, now you notice he talked about the fixed income market is what's, you know, there's Armageddon in the fixed income market. That's how he put it, right? What he's talking about is where investors put their money with funds where they're told by the fund you're going to get 20% per year. Now the fund, you know, they don't really guarantee it, but they sound like it's guaranteed. But the amount you get as an investor is fixed. You're going to get 20% per year, right? That's what the fund has told you. The fund uses your money to make returns much higher than that. They only give you the 20% that they've promised you, right? The rest is their profit, and that's wonderful because they leverage it. When it goes the other way, and they're not just making less than 20%, but they're making losses, and they owe you 20%, they're dead, right? That's what he's screaming about. But he reckons if you can open the window, lower interest rates, right, that'll solve this problem. And but the point is, the thing I want people to understand tonight, which is the main the mechanistic part to understand about what's happening now, is what lowering interest rates means, right? How it's worked up until now, and why the decision by the Federal Reserve not to lower interest rates today is very, very significant. Just before I do that, I want to give you some. I don't know if you guys have had a chance. If you get this EIR, you can read the report in this one. Big bank failure could turn credit crunch into a global crash. But it highlights that there's two particular factors happening now. There's a crisis in hedge funds, and there's a crisis in private equity funds. And there is a difference, right? And I'll explain that in a second. The crisis in hedge funds is on the back of this mortgage meltdown. Because what you have in America is the US mortgage market is $12 billion. Now that's the total value of all the current values of all the properties, commercial and domestic, in America added up. $12 billion, right? And it's all, which is all mortgage basically, unless, you know, if you own something outright, that's not in there. But everything that's mortgage, that's how much it is. Now, no, that's the value of the properties. The leverage goes way beyond that, but that's the value. That's the value of the properties, right? That is what's sinking. So there's a forecast this year, 2007, there will be a 10% collapse in the value of the US property market. So 12 billion minus 10%, which is 1.2 billion, right, is now 10.8 billion. And then they don't expect it to stop this year, which of course it won't. So on that 12 billion, you have $6 billion market called mortgage-backed securities, where certain of the mortgages tied up. Plenty of the mortgages in America are gilt edge, ironclad, straight laced. You know, the holders of the mortgages are very wealthy or adequately wealthy individuals. They can easily pay their mortgages, etc. Right? There's plenty of those in the United States. Remember, the subprime mortgage part is about 30% of the market, right? So the rest is you know, proper mortgages. So not all those get played with, but there's $6 billion in mortgage-backed securities where mortgages are bundled up by the holders of those mortgages and on-sold to other investors who as a security, right, that they'll pay a certain price for, expecting a certain return, backed by those mortgages. And that's called mortgage-backed securities. And then then $3 billion, there's $3 billion in a special type of derivative called collateralized debt obligations. Now, 3 trillion, sorry. Collateralized debt obligations, look up for a definition. It's all very complicated. It's based on sort of, you know, people invest at different levels of risk and they get paid returns proportionate to different levels of risk, right? And some are more guaranteed than others, and they find ways to sort of, this is all done using statistics and computers and, you know, on a daily basis and an hourly basis, and it's constantly fluctuating and changing all the time. But the bottom line you have to understand is this. The mortgages that were issued as mortgage-backed securities, mortgages that were issued as subprime mortgages, right, the dodgy ones, were not issued by banks. They were issued by America's equivalent of non-bank lending institutions such as our Aussie Home Loans or RAMS or these kind of institutions, right? See, banks have, even in this deregulated world, they have certain regulations that they have to adhere to. These other institutions are not regulated. They're the ones that issued these mortgages. Now, where did they get the money? Have you ever wondered this when Aussie and all these companies started up in the last 10 years and all of a sudden they got all the best deals? Where did they get the money? Well, yes, Alan. Ultimately, yes, but they wouldn't even necessarily know that, right? They don't actually really get it from the bank. Directly from them, it comes out of this trading system. These mortgage houses that issued these subprime mortgages would on-sell those mortgages, bundled up, different types. They group them all together. They would on-sell them to hedge funds. Now, when they issued the mortgages, right, they would have already had the arrangement with the hedge fund to on-sell them. I.e., the hedge funds were the source of capital for these mortgages. And the way that what the hedge fund investment was called is a collateralized debt obligation, right? Now, they would enter into this because it's highly risky, but they're hedge funds. Risk is their business. They're playing both sides, right? They've got some kind of deal that if it goes under, right, there will be a payout from some other part of the system that will, even out the risk for them. They're hoping, of course, there won't be a collapse, right? These things are highly profitable at a time when the market's going up, and so for 7 years or so they were great. But that's the hedge fund part. That's where hedge funds are exposed to this financial system. So it's that $3 trillion bubble in collateralized debt obligations that the hedge funds are exposed to, which is what's in a total meltdown now. Because what's happened is the subprime mortgages that were issued, you know how they work. There's what he was calling the teaser rate. People go into these at a really low rate of interest to start with, because that satisfies the computer. Now, if you get a loan now, you don't satisfy the manager or the bank. You go, you give them your figures, and as long as the computer approves of it, then you get what you want. So they'll just, some country hick on work for the dole, and his knocked up girlfriend go to the bank and say, we want to buy a $600,000 property, right? So this is a bit of a challenge, So the guy putting in the figures, or go to the institution, the guy putting in the figures says, okay, he has to play around with what interest rate can he plug in to the equation that will make that loan for them affordable, right? So it's obviously not going to be 5% or 6%. It's going to be more like 1%, 0.5%. That's an extreme example. That kind of one probably didn't happen, but you know what I mean. These are all variables. They'll just reduce the interest rate down to whatever will satisfy the computer so they get their loan. But that particular starting interest rate, that goes for 6 months, 9 months, 12 months, after which, right through the roof, right? So for the last 18 months, you've had this, chickens coming home to roost phenomenon with interest rates hitting all these mortgage holders, and they have been wiped out. Did everyone take notice of the figures that guy ranted about is going to affect homeowners? In the last 3 years, 14. Now that's a figure he just said, and he said he'd read a report, right? That's a figure that he's read in a report, but that's not. I haven't seen that anywhere officially.
14 what was it?
He said in the last 3 years, 14 million mortgages have been issued. 7 million of those people will lose their homes. I haven't seen that figure that he ranted about published officially, right? But he was citing a report. So this has been because what we noticed last year when the subprime collapse started happening is although you got all these subprime defaults growing and growing and growing, right? The increase in new subprime mortgages was exponential. They accelerated issuing new versions of these subprime mortgages in the face of the collapsing existing ones. Just pure desperation, right? Oh, quick, we're sinking, quick, bail, 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 right? You don't plug the hole, just bail faster or whatever. Or in this case, they're pumping, they're bucketing, they don't know what they're doing, they're bucketing water into the boat. So what you got is this hedge fund situation with this wave of defaults. They've been caught flat-footed, and they are losing big time. The losses suffered by hedge funds are always of a certain type, which you call reverse leverage. The world loves leverage, right? Reverse leverage is death. They hate because the benefits of leverage. The losses are the same in reverse. It's just incredible. So who here doesn't understand leverage? Okay. Now this is the principle of our financial system, right? This is the whole thing that it's based on. This is the world according to Macquarie Bank, right? If with a hedge fund, the hedge fund starts off with investors' funds. Now Macquarie's two hedge funds are a good example. One of those funds was $80 million, and the other fund was $120 million. That's what the investors had pooled together into these funds. They're not particularly massive funds, right? But they're big enough. What you'd call a big hedge fund is one where the investors' funds are in the range from 500 million to $1 billion, right? But they're big enough. I remember a couple of years ago, Jamie Packer, while his old man was still alive, and he's because they're a gambling family, he thought, oh well, there's two types of casinos you can play, and he starts a hedge fund, and his was a $100 million hedge fund. All right, so the investors all pony up this money. Then they go to the banks, and based on what they have, the banks will lend them money many times the amount, and it's on a multiple. It's like the normal ratio is about 5, but they'll lend 6 times, 7 times, 10 times, even more. Macquarie Bank's hedge funds were leveraged 7 times. So the roughly $200 million the two funds had together in investors' funds were banks loaned them $1.4 billion. Now, they loan them because they know the types, that it's structured according to the particular deals they're going to play around in, right? These ones were structured according to the collateralized debt obligation and the subprime mortgage market in the United States. But just to give you an example of what you can do with leverage, imagine a fund of $500 million. The banks use a nice even figure, leverage it 10 times. So it's now $5 billion or $5.5 billion, right? Imagine that fund exists just to speculate in oil. So that fund buys $5.5 billion of oil in one day, right? Say at $70 a barrel. The markets are up and down. The next day it's at, I don't know, $70.10, right? Well, based on the leverage, that's a great income, because then they can pay the banks back the $5 billion with one day's interest, whatever that works out at, $5 million or something, for one day at a reasonable rate of interest. What they've got left is about $50 million from one day's investment that the investors who put together the $500 million can share among themselves. That's 10% return on their money in one day. And then they do it again the next day.
Is the yen carry trade, was that,
well,
that was really popular because of that?
No. This is just popular anyway.
Yeah.
This is a principle, right? If you can get this leverage, you leverage your earnings, right? This is great. But you see, take note where the leverage comes from, because it's always going to come back to the banks. Don't worry. Everything in the financial system is a front for them. And that's the big dirty secret that I want anyone to know, right? Because they prefer people to think that they're so prudential and untouchable and powerful and whatever, but they are in deep trouble. That's the principle of leverage, right? That's why they love it. Now, what's happened with Macquarie's two funds, though, the losses they've suffered are an example of reverse leverage, because the 200 million leverage into 1.4 billion exposed to the subprime mortgage market in America, they had to freeze their funds last week because those two funds lost 3%. Now, that's not huge, right? But the banks get paid back first, right? So the banks want what is theirs, plus the little bit of interest or whatever that was owing to them. So the banks get paid back first. The investors carry the losses. But 3% of 1.4 billion translates into something like 25% of 220 million. The investors' funds. They wear that as a 25% loss. Right? That's reverse leverage. So they've got a massive fund. It just gets a little bit burnt on the edges, and bang, the investors suffer huge losses. 3% is really the small end of the potential losses that these guys can suffer in these markets, right? So based on that, based on the 25% loss suffered by Macquarie's two funds, it had to freeze them, because what it cannot afford to have is the investors turning up and saying, we want our money back. Because if they all want their money back, there's not enough money to go around, right? And if the market ever gets a sniff that an institution like Macquarie doesn't have enough money to go around, then, boom, you have the panic phenomenon. So that's the hedge fund side of what's happening now. Macquarie is just one example of it. Bear Stearns in America, one of the major Wall Street banks, right? It's far more exposed, and it's in deep, deep trouble, and that's what got poor old, what's his name, going. Ask me about the yen carry trade in a second, because I'll come back to that. Because the second one is this private equity funds, right? Private equity funds use leverage as well, and what's happened to them is quite spectacular. There's 4 Wall Street banks: Bear Stearns, Morgan Stanley, Lehman Brothers, and Goldman Sachs. They are the biggest holders of junk bond debt in the world. Junk bonds are high interest bonds issued by companies for a multiple of reasons. General Motors, remember a couple of years ago, could only raise money through issuing junk bonds because it didn't have a credit rating anymore. Its actual credit rating was slashed to junk bond status. Junk bonds means it's a high, you can issue bonds, which is bonds are loans, right? You accept loans from people, but you have to pay a high rate of interest, at least something like 10+%, and that's why they call them junk bonds, because the average, whatever the standard, the Treasury rate of interest is, which is 4% or something. The US Treasury rate is regarded as the standard bond rate. So anything like 6% or something above that is you're into junk bond status. Private equity takeovers are all financed, what they call leverage buyouts are all financed through junk bonds. So when Wesfarmers is about to take over Coles, that's a private equity takeover. Macquarie tried to set up a private equity takeover of Qantas a couple of months ago. That one fell through, right? But while that was happening, this year we've all heard these names like Kohlberg, Kravis and Roberts, and all that, which are private equity firms that are geared to run these takeovers. Murdoch has just, his takeover of Dow Jones involves private equity funds as well, right? The difference, they call them leverage buyouts because the leverage is not, unlike hedge funds where the investors pony up the starting money and that gets leveraged. In the private equity world, you have a target like a Qantas, like a Coles, which has a value, right? And you go and get loans based on the value of your target is. Give us loans that we can have the money to go and take that over, right? So you're leveraging the value of your target. That's the difference. You actually don't have any money. The private equity consortium doesn't have any money. They need these loans to do it. And the way they get these loans is junk bonds, right? And when you're being offered that if you invest in this, you'll get, like for big banks and things, you'll get 9%, 10%, 12% returns. A lot of people jump at it. They're pretty high returns, right? Here's the problem. Right now, last year there was $4 trillion in leverage buyout deals worldwide. $4 trillion. You had massive mergers between the biggest steel companies in the world and all this kind of stuff, right? World record, $4 trillion. The first 6 months of this year, there was $3 trillion just in the first 6 months. So the rate of these takeovers was accelerating, right? Just going through the roof. As of now, only August, that has not just contracted, but it's crunched massively down to next to nothing. Those 4 banks I mentioned, they've got all these junk bonds that they're trying to sell, which will be the finance for these takeovers, right? They're trying to sell them, but no one's buying. So as of Friday last week, there's $540 billion in leverage buyout deals that have been done. The share, like with Qantas or whatever, the shareholders have accepted the price, right, that they'll sell out for, etc. All that's got to be done is for the private equity consortium to hand over the money, and there's no money. Now that's a dramatic turnaround from up to the end of June, right, where you had this $3 trillion in 6 months. That's a dramatic turnaround. All that is on the back of what's actually the main cause of this crash and why our poor old mate there was screaming, open the window. Because the liquidity has completely dried up, right? The massive flow of what I described with the new loans issued by banks against the expanded values of the property, that was like taking a garden hose of liquidity, right, and turning into a massive, fire hose of liquidity. That's what we've had for the last 7 years. And the other source of liquidity has been the yen carry trade, where from about from the 1997 on, they dropped interest rates, and then by about the year 2000, Japan went to zero. And they've been pumping money out at zero interest ever since. And that zero interest money, if you can imagine what I've just talked about with leverage, Mike, if you can borrow money for nothing and then leverage it, right? Which is what's been happening all through the financial system. The world has become addicted to this liquidity. But in the last 12 months, the property market has collapsed in places like America, in areas of Melbourne, in Western Sydney. You know, they talk about some places of Australia are still red hot with the property market. Right? You would have heard this, like Western Australia and Queensland. Really? Well, Western Australia has about 2 million people. Queensland has about 3.5 million people. Right? They are red hot. Their property values are through the roof. Sydney, which is in a real crunch, that one city has about 6 million people. So what's going ahead in WA and Queensland is not making up for what's collapsing in places like Sydney, right? So don't be fooled by what you're hearing on the media. The real story is property is a real contraction. And the biggest issue is America. Because the biggest property market is America, and it's collapsed. They reckon it's going to collapse 6% this year. This is according to Moody's. That's the forecast for this year. And then by summer 2008, 3.6% of all American mortgages, according to Moody's, prime and subprime, will be in default. Right? 2.5 million more homeowners will default in their first mortgage alone in 2 years. Second mortgages, that is home equity and other forms of borrowing cash against homes, are defaulting at an even faster rate, 4.8%. Private equity tapping into your homes, right? This is a massive contraction. So the amount of new money being pumped into the system has just suddenly trickled down to nothing, and it's left all these it's left these junk bond deals high and dry. They've got no money. But more importantly, and what our mate Kramer was reflecting, right, is it means the way they've normally smoothed over these problems in the past is not being done this time. And the big question is, why? Well, let's do a little bit of history. So who first, just a pop quiz, when did you first hear LaRouche's forecast that the system was going to crash? Like, how long have you been hanging out waiting for it? 4 years from Mike? 10? Yeah, you've been around a long time, I know. No, 94, June 1994, right? That's when it was issued. So 13 years. You know, what the hell's happened? All right. Where do you start? You start, let's go back, for sanity's sake, to the time when the modern healthy economy was launched. So, effectively it was 1933 in the United States under Franklin Roosevelt. Through a massive investment in infrastructure expansion, new technologies, etc., was called the New Deal. That's when the modern economy was really launched. Then you had a war with the Nazis, right? And what happens, of course, in a war is no expense is spared. And what that did, that attitude of spare no expense, initiated wartime economic mobilisations that were both effective for servicing the needs of war through massive industrial output, but also gave countries like Australia and America and a lot of countries involved in it incredibly valuable productive capacity, right? And you can read about this in our history pamphlet about the wartime economic mobilisation in Australia. Everything was just turned on its head. We developed overnight one of the best machine tool industries in the world, etc. Absolutely brilliant. Now, those principles of sound economics were formalised in 1944 in an agreement among all the nations of the world, or not all of them, but 44 of them that was representative of all of them, called the Bretton Woods Agreements, right? where the Bretton Woods agreements did not relate to investing in agriculture or manufacturing or stuff like that. It didn't relate to that. The Bretton Woods agreements had a sort of like a base level of sanity. Everyone was singing from the same hymn book. They knew how an economy worked, right? The agreements gave a framework of regulation that all countries signed on to, which kept the financial side of the world economy stable. The physical side of the economy, each government was responsible for its own economy, right? But the financial side, all they wanted was stability. That allowed, because once you had stability, then you needed that to create the atmosphere where credit policies could best be utilised to make sure your economy stayed productive. That was all. Well, no big deal. So the basic principles of the Bretton Woods were fixed exchange rates, capital controls, where governments determined what money flowed in and out of their countries, tariff policies that were based on agreements, and they come up with a couple of institutions that at the time were well-intentioned. One was called the World Bank, one was called the IMF, right? And all that was about, the World Bank was quite simple. It was based on the recognition that there's a developed world and a third world, or developing countries, right? Each country can have its own credit policies and issue its own credit for productive industry, etc. But issuing credit, you issue credit against something against which you can get a return. You want to meet the needs of your people, and some of these third world countries are so poor, they don't have within them internally. They can't just make up their own loans, because to get their physical economy to a certain level of functionality, they need outside help. They need to be able to work out deals whereby they can import basic levels of technologies, etc., to give them the starting point they need, right? How are you going to do that? Well, the rest of the world can donate it if they want, but that doesn't, that aid program is always very small. It was more like the idea of the Marshall Plan that George Marshall oversaw after World War II in Europe, right? Which they had to reconstruct. It was a destroyed area. Europe was completely destroyed. So they gave them loans. The Americans gave Europe loans, low interest loans, which the Europeans used to purchase machinery and equipment and technology from American factories, right? It was a win-win situation because they got the benefit of being able to apply those. America's guarantee for its loans was its own industrial output increasing, right? So things like that, and the same principle would apply to the third world. So the idea of the World Bank was, here's a bank that can be dedicated to helping the third world develop. And the IMF is a little bit different. The IMF is more like a recognition that sometimes you can run into certain problems. Countries can have short-term problems, such as, say, a major drought, where if you've got a big industrial agricultural component for your economy, and you have a major drought, that's going to really upset the apple cart, right? You will need to import foodstuffs you didn't have to import before. You have to pay for that. Under those circumstances, you can run deficits, right? Well, instead of the countries going to the private banks cap in hand, the idea was the IMF is a reserve, an International Monetary Fund reserve that every country had special drawing rights to, that in those deficit years, for whatever reason, they could tap into that reserve. And in the good times, they're paying into the reserve, right? That's what the IMF and the World Bank were for. The key principle was sovereignty. None of the agreements of Bretton Woods were in any way about overriding the sovereignty of individual nation states. It was an agreement among sovereign nation states. That was agreed to in 1944. And then Franklin Roosevelt died. And unfortunately, he was replaced by the forebears of today's US government, the neocons, people like Harry S. Truman, the right-wing fascists took over the US government at a time when the British orchestrated the Cold War, and America at that time started to adopt what we now see as a much more imperial outlook. And then because it had weight, because it's America, it had weight, it was able to turn these Bretton Woods institutions on their heads. Not straight away, mind you, not straight away. But things started to change. In the 1960s, America got embroiled in Vietnam. At a time when it was vulnerable, Great Britain pounced. The main stability key, if you will, to the Bretton Woods system was that the US, the whole world's currencies were connected to the US dollar, and the US dollar was fixed to gold. It was $35 to 1 ounce, 35 US dollars to 1 ounce of gold. Interestingly, when they took the final vote at Bretton Woods, the vote was 43 to 1. The one no vote was Great Britain. But it was just expressing its opinion, right? It couldn't, it just said, we don't agree with this, but okay, we'll go along with it anyway. But it waited 22 years. 22 years later, in 1966, at a time when America was very bogged down in Vietnam, incurring big deficits, etc., the Brits allowed gold trading to start on the London market. Now, if gold is fixed to the US dollar, right, and then all of a sudden somewhere it's allowed to be traded, bought and sold, for speculative reasons, the price will change. The price of gold went up. Once the price of gold goes up, right, people weren't interested in sending their gold to America or whatever anymore, right? Gold flowed out of Fort Knox into the city of London, completely bankrupted the American dollar, etc. Had a massive currency crisis, and in 1971, George Shultz, as the Undersecretary of the Treasury, took the US dollar off gold, thus ending the Bretton Woods system. So that was the end of Bretton Woods, 1971, and the beginning of globalization, the globalization era, which is characterized by deregulation of the financial system. We already had the change of national sovereignty was being completely trampled upon by then, right? Deregulation of the financial system. All those principles were thrown overboard. Any country that resisted got smashed, and you can read about that in the book Confessions of an Economic Hitman. That's a good documentation of how it worked, right? Systematically smashed. The Australian government of Whitlam was one of those countries, right? The poor old Whitlam was caught in the middle of this really tense period following 1971, where this total upheaval around the world, and you guys all remember the oil shocks and all that. Ken Larney was the setup. There's a very good book is Jim Cairns' book called Oil and Troubled Waters. Read that book. That's a great book. That's his version of the whole loans affair, right? How that turd, one of my French, president of the Carlton Football Club. No, before him. Elliot's bad. Harrison, is it? George Harrison? George Harris? George Harris, right? Set him up, right? But, very interesting aside, in his book, Cairns reports how the first source of the loans, bear in mind, I interviewed him on this. I said, why didn't you use national banking? You didn't have to go for loans. He said, I knew that. But no one else in the Labor Party was willing to fight for it. So I knew that. I knew the Labor Party wouldn't fight for it. The Labor Party was a different party than the party that had fought for national banking under Ben Chifley. Because they were smashed in '49, because they were out of office for 23 years, by the time they came back into office, only people like Cairns had a real passion for it, right? So he was the treasurer. So that wasn't a political option. So what they did was they went overseas for loans, and they pursued the petrodollars, which has a certain logic to it. He met the King of Saudi Arabia. The King of Saudi Arabia, government to government, was happy to loan Australia the money. Happy to. All of a sudden, when push came to shove, without any real explanation, the deal was off. I think now with these BAE revelations, we're starting to learn what really goes on in Saudi Arabia, right? There's no way the Brits would have allowed their number one asset in the Middle East to finance Australia's buying back of resources from the Brits. It was never going to happen, right? So that fails, and then Khemlani, but by the time you got to Khemlani, the whole thing was a setup. They just fell for it. But that being said, although that's true and it's a whole setup, what most people don't realise is that 2 Liberal members of Parliament holed up in one of the hotels in Canberra on the sort of like the evening before they were going to get really hit. The Liberals were going to smash the Labor Party with all these revelations, the loans affairs and that, and they poured over everything. And these 2 Liberal MPs concluded there really wasn't anything there. And one of them was named John Howard. The whole loans affair, as we know it, was pure PR run by Rupert Murdoch's Melbourne Herald, right? You had a Weasley-looking Pakistani, it was all charades, right? There's no laws broken, no nothing. But anyway, that was just an example. Australia got smashed, countries right around the world got smashed, and those other countries are documented in the book, Confessions of an Economic Hitman. But that was 71. 16 years later, only 16 years later, October 87, you had a bigger stock market crash than 1929. The one-day crash of 508 points, 22.5%, right, in 87 was, in the three weeks leading up to that, the market had gone down 17 points. So it was, from its height, it was a 40% drop, right? Massive meltdown of the stock market, and America's banks went bankrupt. They were bankrupt. Australia's banks were bankrupt. At least one of them was bankrupt. Westpac. You can go and look at and I'm getting old now, but in '94, when we first did work on this, right, it was all fresh. That was only 7 years later, or whatever. Yeah, 7 years later. The bad loans on the books of all Australia's banks, and particularly Westpac, were just through the roof. Unbelievable.
Is that Wales bank?
Is that what was it? Yeah, well, that was what Westpac used to be. Was it still called that up to 87? Was it?
No, 84 changed it.
Yeah. But no, that's what Westpac is, right? So what we were picking up was this big rumour that Keating had to intervene and prop Westpac up, right? That's the kind of stuff we picked up. But before we go what happened after 87, what I want to point out is it took 16 years from 71 to 87 to bankrupt the world economy. 16 years of deregulation where money flowed out of investment into physical economy into this speculative frenzy, and you can go go watch Wall Street, the movie from 1984, right? Greed is good. The world went nuts. In something like February 87, LaRouche forecast the 87 crash. It was one of his famous forecasts. He said, this can't hold out much longer. It's going to, by about October, this will blow. And that was the 87 crash. But the key thing is, what you have to understand about 1987 is the end of the financial system of the world collapsed in 1987. That was our crash. That was our crash. I'm saying that 20 years later. What the hell's happened? What the hell's happened is we've been on a combination of not very functional life support and a hell of a lot of morphine and others of those drugs that you really get to like, right? And it's how that's worked that's kept the financial system looking like it's going until right now, right? But it's about to change. Okay, so what was the first thing? The main thing was, and you've heard LaRouche talk about this in webcasts where he talks about Greenspan and derivatives. Greenspan had just become the chairman of the Federal Reserve, and he said, hold everything. There's a story, this may be an urban legend, but there's a story that our organisation tells in America. I don't know if it's directly true because I didn't hear it from the horse's mouth. I've heard it secondhand, but I think it's true. Where the crash happens in '87. Greenspan was travelling by plane, right? This was before mobile phones. He gets off the plane. He hears, he's just been made the chairman of the Federal Reserve. He hears what's happened in the stock market. He's desperately looking for a phone. He finds a phone box right beside one of our LaRouche organisation field tables, right? So LaRouche organises there on the street, organising, telling everyone that, you know, what's happening with the system, etc. Here's Greenspan in the phone box, freaking out on the phone, screaming, hold everything, blah, blah, blah. You know, this is crazy. And I'm sure, knowing our organisers, whatever state of blood pressure or whatever he was feeling inside the box, they wouldn't have been helping that. You know, sometimes, you know, you see a fire. It's politically it's appropriate to add fuel to that fire, right? And I'm sure I don't doubt that would have happened if that was the case. What Greenspan did was invent derivatives as we know them now, and the way he did it was specifically to bail out the banks. Remember the theme, the banks. It comes back to the banks. The banks were bankrupt. Greenspan invented. Good old Aaron did this for me, not for me. He got these two institutions. He didn't invent them; they were already going, right? These were government agencies that backed that made it easier for people to afford mortgages and that, right? Because they backed. The way they did it is that they guaranteed the loans with government backing to guarantee the loans, and because the loans were guaranteed, that allowed the interest rates to be less than market rates, right? So it was, you know, it was one of these institutions were created by Franklin Roosevelt. So Greenspan got these guys, Fannie Mae and Freddie Mac, to buy all the mortgages that were in default from that were at risk of default from the banks, that were bad debts, right? These bad debts. They bought them off the banks. That was a massive cash injection into the banks. But they've got these mortgages. They bundled these mortgages up into different types, different, you know, there's 10-year mortgages, 20-year mortgages, there's 5% ones, or probably back then it was probably a lot higher than that, 10% ones, 12% ones, like the various types were bundled together, and then they became securities. You could invest in these things, right? Premium, not really premium in the sense of good, but they've got high interest yields because there's a certain various types of risk attached with them, right? And these were mortgage-backed securities. The start of derivatives trading. So they derive their value, they're being passed around as investments, derived from these underlying mortgages that are in a state of real, you know, panic. They're very, very vulnerable, right? But the key thing, none of that mattered. There was a massive amount of money in banks. That's what mattered, right? But at the same time, you got an interest rate policy that he has to start massaging, etc. And interest rates, opening the Fed window, lowering interest rates, you increase. It's like a tap into the economy, you know. If you lower interest rates, the amount of money flowing in is greater. You tighten interest rates, the amount of money flowing in is less. 87, at the end of 87, the total amount of derivatives contracts outstanding was $1 trillion. 1994, the year LaRouche issued his forecast. This is why he issued his forecast. This phenomenon of derivatives had started becoming a phenomena. And if I had had the time, I would have dug up all our different pamphlets on this. EIR issued a pamphlet on derivatives. The pamphlet started with a piece by Lin where he says, he gives a bit of an allegory. He says, imagine if Martians landed from outer space on Earth, they would look at the world economy, and what they would see is a world economy based on pure gambling in the area of derivatives, which were completely inexplicable, and they just pack up and go home. Something like that. That's what then said, and then that was the beginning of our pamphlet on the derivatives situation. That year, the Australian Financial Review here in Australia did a feature on derivatives, what these new instruments were, financial instruments were. They led their feature with LaRouche's quote. They quoted Lyndon LaRouche, American economic commentator or something. Lyndon LaRouche said this, because they'd asked for submissions, and we'd made a submission by just sending them our pamphlet. And they were pretty struck by what it said, because no one really knew what derivatives were. I didn't really get them, right? There was some, it was an investment opportunity that was sold to people as a way you could make a return, and the returns looked pretty good. But there was no such thing as a derivatives expert who could explain how the whole kit and caboodle worked. What we did know is that year, 1994, the total amount of derivatives contracts was $45 trillion. So in 7 years, it had gone from 1 trillion to 45 trillion, right? 7 years. 1994 was the beginning of a lot of financial shocks. You had a Mexican peso crisis. You had the richest municipality in America, Orange County, which they make TV shows about now. OC, Orange County, right? Sport rich brats, Paris Hilton territory, yeah, Disneyland. Orange County, California went bankrupt because of derivatives. The council, the municipal council, lost all their money on derivatives. These were not small events; they were big events. In 1995, it really got hairy. Barings Bank, the oldest bank in the world, evaporated overnight. $2 billion of capital lost in derivatives trading, right? The losses were much bigger than that because of all the leverage. The $2 billion was the capital that was lost, and the bank just evaporated. The massive amounts of losses, and they blamed it all on this trader in Singapore, Nick Leeson, right? And they made a movie called Rogue Trader. So like Kennedy was assassinated by a magic bullet from a lone assassin. They loved the lone assassin principle, right? So Nick Leeson was this lone trader that brought down the oldest, most powerful bank in the world, Barings Bank. We had a ball. I can still remember the day it happened, or the day after it happened. We're in the streets. We just put out a new Citizen with pictures on the front of traders going nuts, with a market meltdown and whatever. We're on the streets of Melbourne. Andrew Bailey had a big sandwich board on, big signs about this, and he came up with a great saying: "The Queen's lost her bearings. The Queen's lost her bearings." Because the Barings Bank's the Queen's bank. That was all derivatives. So these were starting to attract attention, right? Major events. Then 97 happened. And 97 is a very significant year because it was 10 years ago. It was the year of the Asia crisis. Remember the Asia crisis? And it was the year that there was a sort of an inflection point in how to deal with this, through what mechanisms we can keep the system up a little bit longer. The Asia crisis happened because you had all these economies in Asia, like Thailand and the Philippines and that were called the Asian Tigers. I don't know if you remember that, right? And they had big growth rates, 7%, 9%. What we were expecting from China now, that was across all of Asia, right? Massive growth rates. But the reason why was because you had industrial economies like Germany and Australia and whatever outsourcing. Their growth was our collapse, right? Huge amount of outsourcing going to Asia, and it was called economic growth, taking advantage of all the poor wages and whatever. However, overnight, with other things in the financial system going bad, big investors were forced to pull their money out of these Asian economies very quickly. People like George Soros, right? They'd been pumping their money into Asia. They pulled it out. Something like $100 billion was pulled out in a couple of days, investment money. On the back of that, you had a wave of collapses across, and the collapses took the form of currency collapses, right? 30% currency collapses in places like Thailand and the Philippines. Now, 30% currency collapse is an unmitigated disaster because straight away your debt, your foreign debt, jumps. If your currency collapses 30%, your foreign debt jumps 30%, right? Your interest rates jump. Everything, your obligations just go through the roof. You know, you got to give more physically to meet your obligations, right? And this is just a massive wave of bankruptcy that happened. But it was the various machinations in the financial system that caused that money to be pulled out, which was what was really called, and it was called the Asia crisis. It was a worldwide conflagration. Everyone was freaking out. That was the year that Kelvin Heslop and I confronted John Howard and Tim Fisher at the World Trade Center here on the Yarra. They had a big shindig, the Asian Economic Summit, and we sometimes use this picture where Howard's looking out into the crowd like this, because Kelvin Heslop had just asked him about New Bretton Woods, right? Are you going to support a New Bretton Woods response? And Howard's looking out because he wanted to eye these LaRouches before he ignored the question. No, I think I can't remember exactly what he said, but he downplayed it. But you had the guy there representing the World Banker. I remember a Frenchman caused a stir by saying this, forget a recession, this could cause a depression, blah, blah, blah. But the most famous thing that happened was George Soros issued a call for what he called a wall of money. He said, we need to throw a wall of money at this problem, right? And that wall of money became the policy. While you're taking notes, that year, 97, 3 years after 94, derivatives contracts amounted to 70 trillion. So we're getting a bit of a growth rate here. 87, 1 trillion. 94, 45 trillion. 97, 70 trillion. Right? So the Asia crisis was followed by a massive crisis in Brazil. More wall of money. What they called the GKO bond crisis in Russia, which precipitated the biggest hedge fund collapse at that time, this long-term capital management fund in the United States, which had, I forget the starting, I think it leveraged $2 billion of investors' funds into $200 billion, right? And through loans, and on top of that, through derivatives, had something like $1.2 trillion total exposure. And it was run by a Nobel Prize winner, and it evaporated overnight. Right, massive ructions to the financial system. But here's what you saw. The form the wall of money took was interest rates started to go down. You can see this in Australia, you can see it right around the world, right? And people were thinking, oh, we've elected John Howard now, Costello's treasurer, yeah, interest rates are going down. Whoopie-doo. Right, it's all happening. And of course, every government, domestic government around the world, come out taking credit for these interest rates going down. Though, as an aside, I've got to come back to the main point, but just driving here, Costello is justifying today's rate rise that happened today. And he said it's because the economy is strong. The strength in the economy means the Reserve Banks has to tap the brakes a little bit, blah, 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 so the interest rates have to go up. What would he say? What was he saying when the rates were going down? Was he saying because the economy is weak, we've got to drop rates? No, because the economy is strong. This economy is always bloody strong.
He's a great economist.
He is a great economist. They're just so freaked out at ever telling the truth, right? Well, that's how they think of it anyway. So the rates start going down, and in some places they go down pretty spectacularly. And by 2000, Japan's got to zero, which, as an interesting economic point here, zero interest in actual interest is actually a negative interest rate, because what economists call the real interest rate is the interest rate minus the inflation rate. Right? So Japan had an interest rate of 0 and an inflation rate of 1%. They were paying people to take their money. Right? That's the sum effect of it. Was it good to live there in those years? Even street performers could make a killing, see?
Wasn't as good as the bubble time.
No? Yeah.
Bubble finished earlier.
They were, yeah. Oh, you mean in the 80s?
Yeah,
Oh, they were the years.
Yeah.
Yeah, well, because remember, do you guys know that in the crash in America, shut up, the crash in America paled into as bad as that was in 87, had nothing on Japan, because the Nikkei was at 40,000 points in Japan. Do you know what it is now? About 13. Right? What it got to in the 80s. I remember hearing those stories that if Australia, in the late 80s, if Australia had have sold out the site of the Australian Embassy in Tokyo, there would have been enough money to pay off our national debt many times over and all this kind of punk. Anyway, it was pretty big. Anyway, sorry, up to the present. So Japan got down to 0. America got to virtually 0, which was, there was, whatever their rate was equal to their inflation rate, right? So it was virtually 0. And that's the wall of money. Australia didn't go down to those depths, but a lot of other countries went even lower than that. But that was the origin of the yen carry trade. That's when it really started. Because after that, while other countries started raising rates, Japan kept theirs at 0. And they kept it at 0, and they kept it at 0 up until last year. Now, 2000 was when the dot-com bubble burst, right? That was the trigger to actually take it to 0. And like I said a bit earlier, it was a 7,000 point collapse in the Dow. Bear in mind, the dot-com bubble was a bubble based on a fraud, which was the fraud of the Y2K bug, right? But the fraud, again, this principle where government investment starts the bubble, like with the first homeowners grant in Australia, in that case, in the name of Y2K, governments around the world went on massive buying sprees on computer equipment, right? Massive. That's why Bill Gates is a billionaire. It's got nothing to do with how good his program is. It's crap, right? Absolute garbage. That's it's just because that was the, that's what was going on at the time. So people like him became absolute, billionaires. And then in the year 2000, it's funny how it works because we all enjoyed the year 2000. I remember we had a New Year's Eve that year. It's like, okay, count down the year now. Quick, look at your watch, look at the computer. What's going on? Nothing. Quick, get the binoculars. Is there any planes falling out of the sky? Damn, no, all this kind of stuff, right? The planes would fall out of the sky 18 months later. We didn't know about that then, but, we just had to wait a bit. There's a theory for September 11 that we haven't covered yet. That was the year 2000. It was pretty spectacular. For those who are keeping notes, that year derivatives was at $100 trillion. Right? So you got real growth in one area, which is the world derivatives bubble. By 2004, derivatives had risen to $250 trillion. 2005, you had a major inflection point. And bear in mind, I don't have time to talk about September 11 and the political response to this and whatever, right? But this financial stuff is key. One thing that did happen that's notable in September 11, though, which EIR has documented, in the lead up to September 11, you had Enron go under, Global Crossing go under, Tyco go under, big bankruptcies, not little bankruptcies, massive bankruptcies of big companies. Enron was the 8th biggest company in the world or something, right? In Australia, you had Ansett go under, right? Ansett going under is a real bankruptcy. That was the state of the financial system in September 11, 2001. That's why we put out the book, What Australia Must Do to Survive the Depression. It's the biggest single publishing project the CEC's ever done. We did it in 2001 because everything was pointing to this being it, right? And instead, Doug Mitchell and I were supposed to launch the book in Canberra. We had an Ansett flight booked to go to Canberra. September 11 happens. Our launch was the next Monday. Ansett collapses. We had to drive. But then the face of the world changed a bit. EIR documented at the end of that year that when all these banks, I remember when the towers came down. If you remember, there was paper fluttering all over the place. Well, these towers housed major trading banks, right? Major merchant banks and that. What wasn't all that paper? Well, of course, it's a total chaos. You never know. It's just an image of paper going everywhere. When the banks next published annual reports following September 11th, the markets had shut for a week and everything, there were massive changes in their records of derivatives exposure and things like that. Massive changes. Like September 11 was used as a cover to write off huge amounts of their real position, right? And EIR documented that at the time. So 2004 was 250 trillion. 2005, we were just recovering from Bush getting re-elected, right? If you remember that. LaRouche he gets a report every day about what's happening in the news, right? And he got a report that General Motors was paying 6% interest higher than the US Treasury rate. Now, LaRouche knew what that meant, right? And he straight away said, GM is bankrupt. And you guys will remember that because we would have been on the phones to you telling you that, right? Remember the time you get a call from the CEC and all of a sudden we're talking about General Motors? General Motors? What are you talking about General Motors for, right? What's that got to do with anything? GM's bankrupt. This is the biggest car maker in the world, right? The issue was LaRouche's concern principally was always if GM's going bankrupt, the productive capacity represented by that company is going out the window. But what we then started to discover was there were not just implications in the physical economy area, but for the financial system as well. Huge amounts of derivatives exposure through hedge funds was in GM's debt. This is a company with, I forget what it was, $450 billion in debt, right? And its debt was about to be downgraded to junk bond status. And the hedge funds were having a field day in it. Now, because they're hedge funds, they hedge their investments. And I remember in GM's case, it was a very clear case of where the traditional principle of derivatives is if you lose on this hand, you gain on this hand, right? So you always break even. That's how they rig these things. But in GM's case, it went bad. The hedge funds knew they were approaching this date where GM would downgrade it to junk bond status. They were betting on it. They were betting that their exposure to GM's debt would go down. And the way they were betting is they had some special type of derivative, I forget what it was called, that was stood to make money from GM's share price falling. Right? So what they'd go down on this hand, they would make by the share price, they would make from some kind of way that the share price falling would be a financial boon to them. America's version of Kerry Packer decided to buy into GM 5% of its stock the same day it was downgraded. Now, if anyone buys 5% of anyone's stock, that's a big buy. That stock's going to go up, right? So these hedge funds lost on their holdings of GM's debt and lost on their derivative. There was hedge fund chaos everywhere, total meltdown. The downgrade was late May 2005. The month of June, there were bodies rising to the surface, hedge fund bodies rising to the surface all over the place, non-stop. Report after report, this hedge fund saying we're going under, that hedge fund saying we're going under. We were hanging out waiting for the 1st of July. That's when we put out the New Citizen with the headline, The Mother of All Bubbles, June that year, right? Telling people this was what was happening. We were waiting for the 1st of July. That was D-Day, because that was the first day investors, there's only 4 times a year investors can put money into or take money out of hedge funds. And July 1st, we're waiting for that, right? And with the reports in June of, this collapse, this hedge fund going under, this hedge fund going under, these are being reported in the press. There's no way investors, when they had their first opportunity to grab whatever money they got left, wouldn't have done it. July 1 came and went. Nothing. Absolutely nothing. It was incredible. The reality was, it's not that nothing happened. Nothing was reported to have happened. That's a big difference, right? What did happen was July 7th, subway bombs were set off in London. That day, the subway bombs were set off, the Bank of England announced that it had intervened into the market to prop it up, right? So they announced they'd done it that day. How many other days have they done it before that, right, which they hadn't announced, right? There's no way nothing happened on July 1, 2005. Absolutely no way. But you had the second most serious terrorist attack we've experienced, in the last 5 years or 6 years. So this was something really foul was afoot here, right? Next thing we start hearing, because through the press and whatever, all of a sudden you see advertisements appearing that had never appeared before, encouraging pension funds and superannuation funds to invest in hedge funds. They'd never been allowed to invest before. Prior to that, hedge funds were exclusively for the super rich. You had to have a minimum of $1 million to invest in a hedge fund, right? You had to know your situation, etc., blah, blah, blah. But now, they're asking funds to invest in these hedge funds. Pension funds, super funds. Now, promoting them as all these great investments, blah, blah, blah. And massive flows of money from hedge funds and from pension funds and super funds worldwide flowed into hedge funds. That's been the story of the last 2 years. That's what is going to grab everyone's attention this time around with what's happening now, because that wasn't the case 2 years ago. That's why what we're seeing now is super funds exposed to what's going on. They were put in there to prop them up. So 2005, while this was going on, like I said, 2004, derivatives got to $250 trillion. So what we're at now, with all this collapse happening, is the latest figures for derivatives is we're at $500 trillion. This is just out of control, right? LaRouche has said many times in recent period, because he keeps getting asked, when's it going to happen? He says, well, it's a system controlled by a human factor. They will always try and find ways to put it off, but every time they successfully do put it off, they make it worse. And the quantity of worse is that growth in derivatives, right? So if this system had gone down in 1997, it would have been a $70 trillion collapse. Now it's going to be a $500 trillion collapse, right? What we're going to do is we're going to print an edition of the New Citizen in a couple of weeks on the question of this hedge fund meltdown now. Everyone in Australia is going to want to read it because it's Australian hedge funds going under, and it's Australian super funds exposed to it. Ignore the stock market. The stock market is the last measure of what's going on. It sunk like a stone last Wednesday, back up again last Thursday. The massive collapse on, what was it, Monday or Tuesday here? No, Monday here in Australia, right? Back up again yesterday, back up again today, and every day it goes up. It's like, phew, it's over. That's what they report, right? Oh, the market's strong again. And then, that's all just charades. The last 2 nights, the market in America has gone up. And if the market in America goes up, the Dow Jones goes up, the stock market in Australia automatically goes up, right? Because everyone gets excited by it. But if they look at the Dow Jones, what happens in the last 2 nights is it's collapsed most of the day. In the last half hour, it skyrockets. Well, that's just a manipulation. That's this plunge protection team. They just don't want anyone to panic. They've pulled out all the stops. And bear in mind, the other thing to understand about the market is, unlike in 87 and 1929, they came up with certain mechanisms to stop a full-blown collapse in a single day. Now, through these, they got computerized circuit breakers, right? That are programmed that if the trading computers start if the fall on the market reaches a certain rate per minute, they'll switch in and the computers will stop. There'll be a half hour or an hour long breather where no one can do anything, right? And while they've got that window, then Alan Greenspan's on the phone and blah, blah, and they're working. Oh, we've got to plug a hole somewhere. Stop this rout happening. And then when they start, so it's like unlike in the past when there would be a stampede and everyone would head for the exits. They've found a way to slam these big metal doors down on the exit, right? So instead of people getting out, they bang into the doors and bodies pile up. Yeah. But at a certain point, it stops the stampede. That's all that's happening. So any time in the last 20 years, we could have had another 87. In fact, circumstantially, we should have had many more, much worse, because what we're dealing with now is so much more serious than that. Now, so what we're seeing today is this. Just to recap quickly, you got the main sources of liquidity that have been used to keep the system propped up for the last 7 years have completely contracted. There's not that much they can do. LaRouche put out a statement today, right, based on the fact that the US Federal Reserve did not raise interest rates. And some of you might have read it. He said, let it blow. Oh no, central bankers say let it blow. This is what Lynn said. The central bankers have decided to let the system blow up. As of now, the word is let it blow. If nothing changes in the meantime, it will probably happen. It will be horrible. Consistent with this forecast, the Federal Reserve announced from its meeting today that it was making no change in monetary policy or outlook. Why? LaRouche says as they looked at the figures and saw there was no way this could be bailed out. It simply could not be done. For a week or more they counted all their fingers and toes. It's not that they were negligent. They saw that given the scale of the problem and of their resources, it would be worse if they tried to bail it out than if they did nothing. They said to themselves, if we throw our inadequate resources at this, it'll be a disaster. Better save their limited resources for urgent future use. They had to say, let it go. To the question, but what's their plan? LaRouche responded, they have no plan. We have the plan. The only plan they have, if they have one, is to let it go and try and pick up the pieces from the vantage point of them maintaining control to be able to do that, right? Our plan is a Roosevelt plan, a complete reorganisation of the system. This is fake. This 500 trillion is worthless. It's monopoly money. It's worse than monopoly money, right? It all has to be written out of the system. There has to be a massive reorganisation of the world financial system. When you think about the Roosevelt precedent, though, there are certain principles. You know, a lot of this now is a property market collapse. We're not going to be able to keep the market up, right? But what a government should do is step in and make sure no one loses their homes. Now the banks won't like that, right? Because for the banks, that is one of the things where they try and break even in a depression. They just take over everyone's homes, right? Everyone defaults. The banks won't like that, but because you're not going to let the banks foreclose. But on the other hand, we're not going to let the banks close either. The banks would go bankrupt if they weren't able to foreclose. Well, we can't let them go bankrupt either. There is a role in society for banks, right? Just like there's a role, at your doorstep for a doormat. It's a useful thing. You don't glorify it. It's got a job, right? Banks are a bit like that, I think. If we can keep them politically as doormats, where they're there to serve and nothing more, right? Cash our checks, do those kinds of things, they're fine. Any more power for banks than that, they're completely dangerous. But that's what you do with the banks. And then straight away, to stop a depression, to make sure you don't have a depression, because a depression is a man-made event. The definition of depression is when the credit stops, gets cut off fully. That's a depression. You can have a depression that lasts 1 hour. Stop the credit for an hour and then start it again. The key thing is establishing a national bank, right, a government-owned national bank that can start pumping new credit into the system, but in a very specific way, right? That the credit does not go into this leverage into this speculative craziness that just feeds into another bubble, but it goes into it enters the system via the mechanism of new infrastructure, right? The creation of, and we'll need lots of it. Each infrastructure project, big infrastructure projects create massive amounts of jobs, so the money is flowing through the economy the way it should, right? People can, they'll get paid, they'll bank in their bank, the banks can start loaning decent, issuing decent money for mortgages and whatever at reasonable amounts, etc. And the economy starts going again, right? But the flow of credit has to be done in that way. And the other way to do, the other key with the flow of credit is through putting it into high-tech machine tool industry investments. And the key principle here is, you guys, you're probably familiar with the scare, the Peter Costello type scare of funny money, that new money is inflationary. Well, $500 trillion is the definition of inflation, right? They created that, so they don't have a clue what they're talking about. But the question of inflation is always dealt with. The answer to inflation, which in the form of things like, what they're really afraid of, is the wage price spiral. right? Where you get higher wages and then higher prices. The solution is always making sure that you're investing the new money into the things which increase productivity. Because then it's good to pay higher wages. Workers deserve higher wages, but the costs of production come down. Even though you're paying the workers, their share of it goes up through productivity, right? That bridge over the Mississippi River in Minneapolis, that's an important bridge. That carried a massive amount of traffic, goods, materials. What are they going to do now? The costs of business in that part of America has just gone through the roof. Like the cost of business in New Orleans is sky high thanks to the collapse of Hurricane Katrina. The Chinese are about to build a bridge, a 36-kilometre bridge, right, which is seen in the alert, that'll save, what, a 125 or 130 kilometre round trip. That's actually bringing costs down, right? That's what the investment, so the investment costs money, but if you're investing in infrastructure, you're reducing your costs. And if you're investing in machine tools, it's the same thing. Because machine tools is you're creating new machines. And the new machines are producing more for less, right? Because they've got innovations and whatever. And that's why you're very, very specific with where the new credit should go, right? That's the solution. Right now, you know, there's a real fight about globalisation. The oligarchy want to keep globalisation. They'll go to war. They'll blow Dick Cheney and co will blow the world up if necessary to keep it. They don't care if the world's a rubble heap as long as they're on top of the rubble heap. That's their view of it. Literally, they don't care. You know, have massive economic breakdown, trigger a collapse of the world to 1 or 2 billion people, right? As long as we're on top of it. And of course, certain sections of the oligarchy, like Prince Philip, they like to think of it as more deliberately orchestrate that, you know, we don't want more than 1 billion people anyway, because, you know, after I've had, you know, after the Indian natives have grown all the tea I'll ever drink, and the, you know, the African natives have kept the game parks manicured for when I go hunting elephants and rhinoceroses and things and whatever, you know, there's only a certain amount you need in each part of the world that I regard as my birthright. So, you know, I reckon 1 billion people, that'll be fine. Yeah. I hooked my son up with horse face so he wouldn't breed anymore. Things like that. That's their view of it, right? Globalisation. But then on the other, globalisation is the system where corporations had greater power than nation states. But what you're seeing in places like Russia with Putin, in South America with Kirchner and the president of Bolivia and that, is they are in their, they've got big programs to take back assets that were privatised off them, right? They're just grabbing them back off these big companies. They're asserting the rights of nation states over the rights of corporations. That's a Roosevelt principle, right? That's in play at the world. That's a very big dynamic. So LaRouche has called for getting rid of Cheney, getting the Democrats to start a new regime in America so that America, China, Russia and India can sit down, agree to a new monetary system that would be sufficient bulk, right, in terms of the power of those countries, that the rest of the world would you know, the rest of the world couldn't afford to separate itself from a new monetary system agreed to by a combination of Russia, China, India and the United States, right? And if that once again establishes the principle of national sovereignty and, you know, the common good of the citizens. That's the solution. So, I'll leave it at that.